to Industry Insights. Today we're going to run through our review of financial year 2025 and discuss some of the trends that we saw emerging and look at a bit of a forecast moving forward for what we see playing out over the next 12 months. Some of the topics we may have covered off previously, however, I'm hopeful that this will give everyone a bit of a nice review of what's happened over the previous 12 months and a few gold nuggets in there for where to identify some opportunities moving forward. So we'll start with the previous 12 months, and from a development perspective, I don't think I've seen a year where we've had so much structural reform and uncertainty all play out in such a very, very short period. So we've had in the last 12 months the announcement of and the implementation of the Transport Orientated Development Program. We've had the introduction of the low to mid-rise housing reforms. We've had the massive rise in litigation against builders and developers with their personal liability and a few notable court cases and judgments. So personal liability now being in effect for 10 years. We've seen the funding market tighten up more than ever. We've seen construction costs, escalate more so 23 and 24, but continue to escalate for financial year 25. So what's that meant for the industry as a whole? It's led to just a huge amount of uncertainty, and you've seen that with the deal volumes as well in financial year 25. And we didn't trade that many development sites. I think it was our worst year in terms of actual conversion from a list to sell ratio. I think we've traded at just under a 40% list to sell ratio, might even be a tad under that number. And primarily it's because the feasibilities just don't work. And what we're seeing a massive change in developer direction, and a lot of the I'd say more your affordable developers having to pivot their businesses to a higher GR suburb. And it's not out of a desire of not wanting to actually deliver more affordable stock. It's more so that they have to do it to be able to turn a profit. We're talking to obviously builders and developers every single day, and I haven't had a conversation with anyone recently whose construction number is under $500,000 an apartment. And that's groups who 2 or 3 years ago were doing it in the low 300s. We're talking over a 50% surge in construction costs in a very, very short amount of time. So we're seeing that the sites that have been traded and the sites that have started over the preceding period are groups that already own those sites. So they were transacted in the previous years, and they were going to build them anyway. What they have done is a lot of the groups who hadn't started is use the 30% of infill affordable housing bonus, particularly on major projects. And we've seen a few groups such as Urban, A-Land, Daycorp, really Landmark. A lot of them have implemented the infill affordable housing bonus into their projects, and that's pretty much all across Sydney, across all of their suburbs, which is a big positive. And we have seen on the flip side, all the small projects in our middle ring suburbs essentially be shelved, and they've been the hardest ones to actually trade. So we're talking suburbs in that 8 to 15 kilometre ring of Sydney, that with GRs in that $12,000 to $15,000 a square metre. So you're talking your $850,000 to $1.1 million for a 2-bedroom unit. The land prices in those markets have been massively compressed, and in the sub $12,000 per square metre market, it's almost impossible to trade a development site, not unless the owners are willing to take a massive hit on what they thought their site value was only a couple of years ago. So a lot of pain. To summarise, there's been a lot of pain in the industry. Not many groups actually very profitable. We've seen that also with the closures of so many construction businesses and associated businesses over that time. And a lot of the groups that we're dealing with, particularly our clients, is restructuring their businesses to adapt to the new regime. So that is finding solutions for their previous sites and making sure that their processes, their quality, their pipeline, their customer experience is being evolved to deal with the new wave of demands from buyers, deal with the new wave of demand in compliance and funding, because if you're not elevating, you just won't be able to survive in Class 2. So leading on to the future and what asset classes are going to be in demand, what are in demand today, and what we see moving forward. So out of the Class 2 space, with the massive shift in the dynamic in the landscape, there's been just a massive withdrawal of Class 2 builders, particularly groups that were doing smaller projects, 10 or 20 apartments. And that's shifted to a massive surge in demand for Class 1 sites. So we're seeing a huge amount of demand for well-located duplex, housing and Class 1 townhouse sites, particularly in luxury suburbs. So if you're talking that inner ring of Sydney, so the eastern suburbs, the lower North Shore, even the southern Sydney and inner west fringe, if you were to go to a substantial duplex site or housing site auction on a weekend, you'll find multiple bidders. And a lot of those buyers are actually the buyers that were buying small apartment sites only a few years ago. So quality housing sites and duplex sites, particularly of scale in inner ring suburbs, are super competitive. And we're seeing developers accept margins in that 10 to 15% range and doing 2 or 3 of those projects every 18 months just to keep themselves ticking over. And we're still seeing that end user demand. However, there has been a slight drop off in the actual revenues of some of those duplexes, particularly in the inner west. Another asset class that we've noticed a substantial shift in the last few months is income generating residential and established residential stock. So here we're talking about apartment blocks, co-living boarding houses that are operational, and established residential, so residual stock. We'll start with the apartment blocks. I mean, ultimately they're a safe haven, and the demand has predominantly been from investors, I'd say in their mid-40s and onwards. So we're talking about seasoned investors or well-resourced individuals who are looking for a safe place to park their money. The share market, with obviously the tariff announcements a couple of months ago, wiped 22% in one day. So that led to a massive withdrawal of cash from the stock market. And a lot of these buyers are now chasing safety in residential, particularly in suburbs where they can buy below replacement cost. And in those suburbs, we're seeing a sharp compression of cap rates. If we looked at January or November 2024 or January 2025, you could probably buy an apartment block on a net cap rate in the 4 to 4.5% range. Now you're sort of talking, depending on where it is, I'd say if you go Western Sydney, maybe 4% net. If you start heading into the middle ring, that 5 to 15 Ks, you're in that 3.5 to 4% cap rate. And if you're going premium eastern suburbs, the last few sales have all been a sub 3% net return cap rate, which is super competitive. So you can see buyers are happy to take a much more passive return, and bank on the underlying land value appreciating over time and rents gradually continuing to grow. Now that's driven obviously by the drop in interest rates and the global uncertainty combining into one. But as interest rates cut down and the world seems to be getting crazier and crazier around us, we only anticipate that the demand for established residential blocks will continue to grow. Now we haven't seen that translate yet to co-living and established boarding houses. So looking back, end of 2024, early 2025, co-living and operational boarding house assets were trading in cap rates, give or take 5.25% to 5.5%. Now, if you look at the spread of that to your established residential, that's about 1 to 1.5% difference in the cap rate. Now, we've had a tightening in the apartment block cap rates, and we're yet to see it in the co-living and the boarding house space. So we anticipate that as soon as purchasers can work out that the yields aren't as desirable in apartment blocks and they've compressed too far, they'll shift their attention to co-living and to established boarding houses. And we'll start to see a compression of those cap rates and a lift in the rate per key. So that's a very interesting asset class to watch. Keeping the flavour of residential, we've seen a big surge in established apartment values, particularly for apartments older than 20 years. So that have, aren't necessarily part of that big boom in the mid-teens, like 2015 to 2021, that are well established with minimal, I guess, building risk. We've seen a huge growth in those apartment values. In some areas, it's been well over 10% in the last 6 months, driven primarily by affordability and safety. So a lot of the rental growth over the past 12 months has essentially made a lot of those renters become first home buyers, and because their mortgage rates now with the last couple of rate cuts essentially is equivalent to paying rent for that same property. So I think if you look across the good suburbs in Sydney, so key suburbs in the inner south, the Shire, the inner west, anything along the transport corridor with good amenity, it's a very, very safe bet buying established residential, strata apartments in those key suburbs, because they just can't be replaced. You won't be able to replace them for that price that you're able to get in. And as the population continues to grow, and it will, and our immigration numbers continue to grow, and they will, there's only one way that those asset classes are going to go, and that's up. So everything residential focused that's established, we can only see one direction in those prices, and that's up. Quite topical at the moment is I want to touch on the purchaser response to the low and mid-rise housing reforms and the transport orientated development program, because we've run a few campaigns now, and we've learnt a lot of valuable lessons in terms of purchaser sentiment, and there's starting to be a very clear pattern on what's transacting and what's not, and what site issues purchasers are very conscious of when they're looking at particularly the low and mid-rise housing sites. Putting location and basic fundamentals of site assessment to one side, let's focus particularly those around low and mid-rise housing. One is the site constraints itself. Can the site actually handle the density in a compliant built form? There is a clash in the legislation between the DCP and SEP 65, the Apartment Design Guide. All buyers, until there's a court case to prove otherwise, are relying on SEP 65 as their design principles for their acquisition and planning. So as a vendor, if you're planning on selling a site, you need to make sure that your site can actually handle that proposed density. And the setbacks that are proposed are quite substantial. So what does that mean for the site to make it work? You need to have enough frontage to be able to handle the site setbacks and filter built form. So if you have a narrow, skinny site, start talking to your neighbours, because the sites that are transacting well at the strong rates on the attractive settlement terms are the ones that present zero planning risk to the buyers. They're all happy to take the journey on and take on the councils as long as they're comfortable that the baseline planning is compliant. When we're talking about location, there are certain areas and certain patches where there seems to be what's projected to be a future oversupply. And the market that's causing, I guess, the most concern in terms of the future supply lines and where the revenues are going to be is that Mossman, Neutral Bay corridor, either side of Military Road. And we're starting to see a very clear tiered pricing on the site values. So I've had some buyers talk to me that on the North Shore, they've had in excess of over 200 site opportunities tabled to them. Now, I don't know if that number's a bit exaggerated or not. I couldn't tell for sure. But what it does say is that there are a lot of opportunities. And if you essentially look at the maps, pretty much 400 to 800 meters either side of Military Road has been rezoned. And what that's going to mean is that there is just going to be a massive future supply of opportunities. And there are more sites than there are buyers. So if you're positioning your site ready for sale, I think it's very important that you understand, one, is your site compliant? Okay, you've passed the compliance test. Two, what unique features of your site, what do you have relative to the one across the road, the one on the other side? Do you have views? Do you have good access? Do you have good outlook? Are you on a cul-de-sac street? Do you have traffic noise? Because if there are going to be so many sites and so many projects delivered, buyers are ultimately going to have more choice. So if you are a stock standard site and your apartment is going to be no different to the apartment down the road to the apartment down the road, that only leaves one real trigger point for you to be competitive with, and that's price. And in a luxury market, in a higher GR market, competing on prices, it never really works out well for anyone. And buyers are very, very dialed into this. So, to all the landowners out there, and we're very conscious about this in the sites that we're pitching on and working on, you've got to have your revenue argument and your point of difference. So as a landowner, you can solve that with time, giving developers more time to de-risk the site, get some pre-sales, reduce their upfront capital requirements, improve their return on equity. That can preserve your land value. Or if you've got something special, know exactly what is special about it and find the buyer in the marketplace that actually wants those attributes. Markets in the low to mid-rise where we haven't seen a huge amount of supply, and I don't think we're going to actually see it, but we still feel there's some interesting opportunities. Class 1 R2 sites. Now, this is mostly in 3 core locations. St. Ives as one suburb, French's Forest and a couple of other suburbs on the northern beaches, and southwest Sydney. Now, in those 3 suburbs or those 3 regions, you can still buy, well, you can buy, there aren't many, but there are class 1 sites, so we're talking R2, where you can do a class 1 townhouse development of scale. And there's only actually a finite amount of these opportunities available, and we're lucky enough to be appointed on one of those, which we'll be bringing to market in a few weeks' time. But this is a golden opportunity for developers who've exited the class 2 space. Now, let me ask you, would you rather be doing a luxury house or a luxury duplex with a GR of 30 million, or would you rather have 11 townhouses at 2 to 2.5 million for the same GR? The returns are a lot healthier. Your risk exposure or your outlay is pretty much identical across both projects, but your profit margins are probably double, if not triple, if you were to consider these sites. So I'm doing it personally, and I'm encouraging anyone who'll listen to be out hunting, really focusing on those low and mid-rise housing markets, particularly on the R2 and R3 land, and look at where you can do townhouses of scale. And the site requirements are nowhere near as onerous as they used to be. Now, there's not an abundance of these opportunities, but there is a huge margin, a big opportunity for groups that are willing to go in and actually get those sites under control and deliver. And if you talk to any residential sales agent, they'll tell you the most affordable product and most in-demand product is townhouse stock in almost any Sydney metro market. So that's what we think is a real golden nugget in all of the low and mid-rise reforms. Looking in the east, again, Randwick, there's a handful of sites, but again, that could be a market from a class 2 perspective where we still feel there's a lot of value to be had. And if you're able to secure, we are appointed on one at the moment. Hopefully, it will be sold by the time this episode goes live. But focusing on those areas where there hasn't been a huge amount of previous supply, and you can see that there's not a lot of amalgamation opportunities moving forward, Means if you're able to do a Class 2 development of scale, you'll have next to zero competition moving forward. So Randwick and the Southern Corridor is where we see a lot of that opportunity, and also the Upper North Shore. So Pymble, Turramurra, we think also there's quite a fair bit of opportunity there. I'm going to move on and wrap it up with my predictions for the coming financial year on a few key areas. So site values in Middle Ring. So Middle Ring, 5 to 15 kilometres from the CBD. I'd say they're probably going to hold, if not contract moderately. That's primarily down to a continued rising construction cost. I think the larger the site, the more likely it is to hold in value. The smaller the site, more likely it will continue to compress. Site values in outer ring suburbs. So we're talking, Parramatta and out. In the west, we're probably talking, for Rockdale and further south. We're probably talking Pymble. Oh, let's go even further. Let's exclude the north. Let's talk about the northwest, perhaps even Kellyville and out. I can't see anything in the short term that's going to lead to a massive increase in land value. We're more likely heading down. If you have a site of scale in these suburbs, you really need to think about either finding a way through the planning, whether it's through the Housing Delivery Authority, whether it's through the infill affordable housing, to add whatever value you can through the planning. Look at your approvals, whatever you can do to optimize your design in terms of efficiency. And 3 is you've got to look at your transaction structure. If you're not able to deliver these sites yourself, it's highly unlikely you're going to be able to sell that site for a profit if you bought it recently. You're likely either going to have to be flexible on your land price or flexible on your transaction structure, or possibly even consider bringing in a delivery partner where you'll input the land, raise the equity for the construction from your incoming partner, and work out a partition. There's definite growth in the stock, but the land, I just don't see it in the immediate term unless there's another trigger pulled by the government in form of a tax relief or some sort of incentive, that those values are going to continue to go up. Premium GR suburbs, I mean, this is a little bit loaded, but I think it is more location specific. Anything that's got a unique downsizer perspective, beachfront, harbour views, on a golf course, something that is very, very unique, those site values are going to continue to rise because there's only a finite supply. We've still got a continuing aging population. They're going to continue to grow up. The next tier down, I think premium suburbs, so GR of 25 a square metre plus, but with a reasonable amount of supply. So if you're in a Todd precinct or an LMR precinct, highly likely those land values are going to hold, maybe decline slightly. And I say maybe decline slightly, that will come down to the deal terms itself. If you're not flexible on time, buyers are going to chip you on the price. If you're willing to leave your land in for a delayed settlement, your land value will probably hold, if not grow. Cap rates on established assets, we'll go apartment blocks, definitely going to compress, value is going to continue to go up, with the caveat, only with the caveat that they're rented at market. I think anything that's rented under market, the cap rates are always going to be tight because buyers are pricing in the value of the existing asset. So if I have a 2-bedroom unit that should be rented at $800 a week and it's currently rented at $600 a week, they'll probably still sell for a similar number. Obviously that'll show a sharper cap rate, but I'll talk about on a rate per apartment, I think it will stay very, very similar. Co-living, my call is that the cap rates are going to compress, prices are going to go up, the rate per key is going to go up. They're by far the biggest and most in-demand asset class on a rental side. We've had the largest amount of rental growth. They're our number one in terms of inquiry numbers. Households are getting smaller. More people want to live on their own. They're happy to pay a premium to do so, especially in the right area. Market, I think for apartment blocks is going to get too competitive. Cap rates are going to get too tight, and co-living will come in, and those values will continue to grow. Industrial, it's a bit funny. Look, we think they will compress, particularly the newer assets that don't need work with good tenant covenants. They're going to continue to come in. However, if it is a older style or it is strata, depending on where it is and how old it is, we're not seeing a huge amount of growth in that stock, in older and strata stock. So very conscious on the quality of the asset. Wrapping up, the next 12 months is going to be really exciting for our industry as a whole. A lot of the established players know where they're heading and have very clear timelines. However, whoever can actually solve delivering quality housing in a good suburb at a reasonable price. When I say reasonable price, there's always going to be a price that you need to pay above and beyond established stock. So you're going to be a winner. And I say this to all of my colleagues and our clients in the development space. There's a unique opportunity at the moment. You've got most of our competition leaving the industry. You've got a genuine housing crisis and affordability crisis out there. And you've got a unique window where the planning environment is in your favor. Let's use it. We all have to we all have to lift our standards. We all have to improve our quality. We all need to be a lot more accountable for what we do. We all need to deliver a better experience for our customer. But they're complex solutions. But if we want to be in this industry long term, and whoever can actually nail and come up with these solutions, there is a lot of money to be made. And we're really excited about what that holds for us as a business and what it holds for our clients, because there just aren't many people out there doing it anymore. And this is a great city where everyone wants to live. So it's time for us to step up and elevate, deal with these challenges head on, and let's focus on where we can deliver value for our customers. I think if we keep doing that, we're in for an exciting fall.